There are a handful of powerful individuals that control most of the wealth in tech. In fact, if you trace the origins of the largest companies, Uber, DoorDash, Amazon, Facebook, you'll find the same names keep coming up over and over again, acting like puppet masters behind the scenes, pulling the strings and deciding who gets into the club or not. They're called venture capitalists, and their blessing can make you rich beyond your dreams, and their rejection can condemn you to the entrepreneur graveyard. Today, I want to pull back the curtains and talk a little bit more about who are venture capitalists, how do they think, what are they looking for, and ultimately, how can you get them on your side? My first encounter with venture capitalists was in 2015 when I was raising money for my startup, Prodigy. I had just moved to Silicon Valley, I was full of enthusiasm and energy, and I was like, I'm gonna dent the universe, I'm gonna make a difference, this is my startup, we're gonna get so much funding, people are gonna love it. And at the time I was about 6 months into my startup. I'd hustled my way into an investor demo day, I gave my pitch, hundreds of investors were watching, I knew this was my moment. And then I spent the next 3 months driving up and down Sand Hill Road every single day, meeting with investors, giving my pitch, asking them to invest in our startup. And the experience was one of the coolest things I've ever done. I got to meet with industry titans like Alfred Lin at Sequoia, co-founder of Zappos, now one of the best investors in the world. I directly pitched him my startup. But then the bad news came, and it kept pouring in week after week. Investors were not interested in my company. They kept saying no. And they wouldn't say no outright. They'd say soft things like, you know, we think you're just a little bit too early for us. Or, you know, we're still thinking about the market. We'd like to wait for the next round. It all sounded really pleasant, but at the end of the day, my startup needed funding and they weren't giving it to me. But what was interesting was a year later, I did another investor demo day. And that one was totally different. Those same investors that had rejected me flat out were begging to invest in my company. We ended up turning down almost $12 million of interest in our startup. Now, the reason I'm telling you this story is because I want you to understand that raising money from venture capitalists is a game that you can learn to play. If you know the rules and the fundamentals of how it all comes together, you can get funding almost every time. But if you're like me, new to Silicon Valley, don't know what you're doing, you're gonna get rejected nearly every time. Now, the first thing you need to understand about venture capitalists is they are not who you think they are. Most people think venture capitalists are just friendly people who have a bunch of money and want to invest in the next cool startup. So they look at pitches, decide what they like, and then invest. That's not how it works. VCs are hired guns. They are not investing their money. The money that they invest actually comes from what are called LPs, aka limited partners. And as a venture capitalist, when you raise from limited partners, you make certain promises, certain guarantees to these LPs on what you will invest in and what you will do. So even if the venture capitalist likes you, they cannot invest if it doesn't match what they've promised the LPs. So they are beholden to these LPs. So if we want to talk about venture capitalists, we first need to talk about who are these LPs and what do they want. And the first thing you need to understand about LPs is they don't give a damn about your startup. LPs are not tech investors. They're not passionate about what you're doing. They are generally large endowments, large banks, institutional investors, big investors writing $50, $100, $500 million checks into these venture capitalists to get them to go to invest. Now, why are they writing checks into VCs? Well, it's simple. They want better returns than if they invested in the public market. And so that comes with high expectations. If they had just put their money in the S&P, over the last 100 years, the average has been a 10% return. So the venture capitalist needs to beat that if the LPs are going to stick around and continue to invest in venture capital, which means your startup needs to grow significantly faster than the average business. And LPs are cutthroat. If a venture capitalist has a bad fund, even after multiple successful funds, they will pull their money out and look elsewhere. So as a VC, you're always wondering, how can I find the next startup that will deliver market-beating returns? And to put it all in context, the typical money split in a venture capital fund is 80-20, as in the returns that the fund generates, 80% go to the LP and 20% go to the venture capitalist or the GP. So you don't have to be a rocket scientist to figure it out. Just follow the money. 80% of the returns are going to the LP. They're the ones funding the business. They're the ones that they need to impress. And so at the end of the day, venture capitalists are only looking for 4 things. And if you know what these 4 things are, you can very easily talk to them about your startup, show them how you match what they're looking for, and get a check. But the bad news is, if you fail just one of these 4 things, the VC cannot invest in you. It simply doesn't align with what they're looking for. So the first thing VCs are looking for is what's called thesis alignment. Now, the thesis is what they told LPs they were going to invest in. So if they went to LPs and said, listen, we're going to go invest in the next generation of direct-to-consumer brands, they cannot invest in your health tech startup no matter how good it is. They are looking for direct-to-consumer brands. So it's really critical when you're pitching VCs that you help them understand how your business actually aligns with their thesis. Usually you can find it on the website or just by talking to them. The second thing VCs need to invest in your startup is a billion-dollar outcome potential. Now, it's obvious that not every startup a VC invests in will turn into a multi-billion-dollar company. That's just not how things work. But you need to have the potential of being worth billions one day. After all, these LPs are putting in hundreds of millions of dollars, and if they just wanted basic returns, again, they would just go to the S&P 500. So you need to have a very large market that you have a potential to dominate to interest VCs. The third thing, and the thing that no entrepreneur likes, is ownership. Venture capitalists can't just own 0.1% of your business and generate the returns they need. A typical venture capitalist will need to own 10 to 20% of your business in a single fundraising round in order to get interested. If it's too small, they just don't get enough ROI on their time and money, and they have to look elsewhere. So get ready to give up some of your company if you're going to venture capitalists. And the last thing, and maybe even worse than the ownership, is venture capitalists need control. At the early stage, pre-seed, angel, seed round, they won't need that much control, but Series A, Series B, they're going to take board seats, they're going to take voting rights on your company. Ultimately, they need to be able to steer the ship if you start making decisions that are not best for the VC and their LPs. And so because of this, VC is a bit of a dangerous drug for startup founders. If you don't know what you're signing up for, you can be in a world of pain. The expectations are extremely high, not just from the VC, but the LPs backing them. And so it can feel really fun when you first raise that money and you have all this money in your bank account. But when the dust settles, it starts to sink in what you've really signed up for. You have high expectations, and if you don't perform, they will fire you. And I've seen this firsthand. Now I'm actually an LP in a bunch of funds that backed me. And so I get to see exactly how these venture capitalists speak to the LPs about the companies they're investing in. It's pretty brutal. As an LP, I get a quarterly report of every startup the fund has invested in and how that startup's doing. Has the valuation gone up? Is it flat or is it declining? And they rank them best to worst. The reality is, if you are not in the top 3, top 5 companies on that spreadsheet, the venture capitalists, I don't want to say have written you off, but they're not going to give you that much attention unless you can get yourself back to the top of that spreadsheet. So if you're in a market that's growing slowly, if you're not getting the traction that you thought you were going to get, it's very likely the VCs might start to write you off. This can make future fundraising rounds extremely challenging, but it can also just slow your business down in general. Without the support and network a VC brings, it can be really challenging. Now, having said all of that, I think venture capital is one of the most magical things about building a startup. Unlike other businesses like a service business or an e-commerce business, you literally get people paying you millions of dollars to build your company that you can one day sell. In fact, I raised $21 million for my startup, and we sold it for a very good multiple on their money and, of course, my time. If you want to see exactly how some of my earlier rounds played out, I just did a video that I'll link over here on how I raised $5.4 million in just 3 weeks. Just click the link and I'll see you over there.